Hello and welcome to another discussion in a series regarding mergers and acquisitions being presented by the San Diego corporate law firm of George P. Shenas Incorporated. I'm George Shenas, the host of the series, and today it's my great honor and pleasure to have join me on the set Phillip Currie. Welcome, Phillip.
Thank you, George.
Phil is the founder of Shoreline Partners, a San Diego-based investment banking firm with a substantial and successful career since 1992 when Phil founded the organization. Shoreline Partners, for your information, specializes in representing sellers having a range of revenue somewhere between $10 million and $200 million in connection with their efforts to sell their businesses at the most profitable level possible. Given the fact that as we stand now, most of the measuring rods by which the value of companies are established are down. How do we deal with that? We're talking about a marketplace in which revenues are down, gross profits are down, earnings are down, the multiples in the public marketplace are down, PE ratios, EBITDA multiples, and the like. As an investment banker, you have a challenge on your hands in posturing and presenting that company in the best possible light. What are some of the techniques and approaches that you take to do that?
Well, first of all, you want to look at the history of the company to see what their success has been in a normal market, and that needs to be presented.
This is called normalizing?
Normalizing the income statement. But there's more to it than that, and that is that each business has very unique magic, as we call it. And that magic has to be evaluated to determine what its value would be to others. And it needs to be amplified and emphasized. The other element to evaluate is called the recasting. We do early on in an assignment evaluate those expenses that are attributed to the company in the past year or 2 or 3 years that may not be incurred by a buyer. So we can improve the picture of the business by recasting the income statements. We identify that it is recast, and we identify to all the buyers what we are doing to recast that.
You more or less footnote the historical data and make adjustments to historical presentations to reflect the changes that would be necessary to recast for the present circumstances.
That's correct.
Yeah. This information, of course, is embodied by you in the marketing presentations that you put together, the book, so to speak, as you're going out to market the product, or product line, or the entire company, or whatever the case might be.
It's our posture that basically the tax returns, which are the base income determinant, do not necessarily provide the best picture of the capacity and profitability of the company, of a privately held company. So that we like to evaluate that to see that, for example, if the owner's compensation we believe is excessive, we might adjust that going forward because the buyer would not incur those high ownership costs, and to increase the bottom line apportionately so that the company presents itself better than maybe a tax return. However, we always disclose what we are doing here to make sure that we present the company in the best light. The future here is the one thing that really we need to focus on right now, and that is because we're not, businesses are not, their performance is not as it has been in the past, and we believe it will return. We're looking forward to perhaps a turnaround in a year or so. And we're also looking how the competencies and magic and capabilities of the company might perform in the future. The buyer is always focusing on what the future is going to be for this company. The seller often focuses more on the past, which is not necessarily the right thing to do. Because in terms of today, when you have a down market, we're much better off focusing on what could happen with this company, particularly in the hands of a strategic acquirer who may be able to do more with the company than the seller could themselves.
There's a great challenge on your part, is it not, that once you define the essence of the seller company and that magic, as you put it, that makes its value, that creates its value, then identifying the fit with a company that can capitalize most significantly on that element is important.
That's the creative part of marketing a company. There's an adage in our business that goes that the buyer seldom buys what the seller thinks they're selling.
Huh.
The business itself is the ultimate product, not what it's making or not what it's producing. So we dig down deeper into the organization to find out what its capabilities are and try to identify what could occur. And one of the interesting things here is that oftentimes businesses are not able to pursue the real opportunities in front of them because they do not have the financial capacity to do so. However, when a company is up for sale, the buyers often have the capital to do whatever the opportunities are. So those untested or undelivered opportunities need to be identified to attract new, different types of buyers, as well as to increase the value to the particular buyers.
Phil, we've had a great deal to cover on this, and we have more to cover. So I'd like to take a break here at this point and reconvene at a later point in time to further our discussion. Thank you.